In this example problem, we are going to sell some inventory to a customer, but instead of taking a traditional accounts receivable, we are going to take a notes receivable. And what's the difference between the two? Interest. Accounts receivable typically don't have interest tied to them, and they're very short in the length of time. You may remember credit terms from financial accounting of like 315 net 30. The net number is how long they have to pay the full balance. It's usually a month or two. For a note receivable, it typically has a longer period of time. So in this example problem, we're going to once again be Banjo board games. We're selling $240,000 worth of inventory to Imagination Station. In lieu of paying us at the time of sale or even taking a traditional accounts receivable, we are going to accept a short-term notes receivable from Imagination Station. And the information on it is as follows. If we're giving them $240,000 worth of inventory, the face value of the note is going to be $240,000. We are going to allow them a whopping 10 months to pay us right now, but the catch is that we're charging them 5% APR interest while this note is outstanding. We need to record the journal entries to account for all of these different transactions. So let's go through and start on September the 1st. And on September the 1st, this is the point in time where we are going to make the sale to Imagination Station Incorporated. And they are going to sign us a promissory note saying that we are eligible to receive $240,000 plus applicable interest sometime in the next 10 months. So we got to put the notes receivable on the books. And notes receivable, just like accounts receivable, is an asset account, increases on the debit side. So let's put the note on the books for 240 grand. Why are we getting the note? Because we sold them inventory. Well, you still have to put the sales revenue on the books in the period that we met the obligation. Our obligation was to transfer this inventory that they wanted to sell that we apparently produced, and we did that. We gave them the stuff. So the sales revenue, even though we're probably not going to get paid for months and months in the future, has to go on the books at the point of sale on September 1st. And here we sold inventory and received note. And this note will be outstanding. They don't owe us monthly payments. It's typically not the way that notes receivable work in business. You usually pay the lump sum at the end of the note's life, plus any interest that is accrued on that note in the interim. But the catch is we need to make sure that all revenues that we earn on in a period of time go on the books in that period of time. And I'm willing to bet on December 31st, 2025, Banjo Board Games is going to have to make its financial statements, namely its income statement. And any interest that is accumulated on this note within those 4 months between September 1st and the end of 2025 has to go on our 2025 books. So on December the 31st, we're going to have to make an adjusting entry. And in this adjusting entry, we are going to have to figure out the amount of interest that is accumulated on this note in that time frame. Well, principal times rate times time is always going to be our interest formula. So we know the principal amount. This note has a face value of 240,000. It was given up here. We know the stated rate of interest that Imagination Station agreed to when they signed this note with us, which was 5%, but that's 5% APR for the year. We didn't earn a full year's worth of interest because this note's not been outstanding for a full year. It's only been outstanding for September, October, November, and December. That's 4 months. So times 4/12. And that comes up to $4,000. We're not getting paid that $4,000 right now. Again, they don't have to pay us until 10 months into the future, or well, 10 months until from the point that we sold that inventory to them. Uh, so we're not getting cash right now, but they owe it to us. Even if they paid us early on January 1st, we'd make them pay this extra $4,000. So we are officially entitled to receive that interest at this point in time, which is why I'm going to book it to interest receivable. And again, the reason that you make adjustments is to make sure that all revenues and expenses are recorded in the period that they are earned. And this interest was earned during 2025. So I'm going to record that interest revenue right now as well. And in this entry, we adjusted for accrued interests on Imagination Station note. So we are GAAP compliant by using accrual accounting to put that interest on the books in the time frame that it accumulated on the note. Well, we still got to get paid on this note, and then we're going to get paid on this note July 1st, 2026, which is exactly 10 months from the day that they took it out originally. So on July 1st of the following year, we're finally getting paid for this inventory that we sold so long ago. Well, we're getting paid, so we're going to need a debit to cash to increase our cash account by the amount that we're being paid. And we'll figure that out in a second. How much cash are we getting? Well, firstly, we know that they got to pay us the face value of this note. So we're going to have a credit to notes receivable, taking it off the books because they're no longer owe it to us for whatever that value is, and it's been 240,000. We also know that they have to pay us this interest that we accrued on the note previously. So interest receivable. They're no longer going to owe us that $4,000 that we already put on the books in our year-end adjustment. That's got to come off. But $4,000 isn't the full amount of interest that accumulated on this note between September 1st of 25 when they signed it and July 1st of 26 when they're paying us. More interest got tacked on since we made this adjustment. So we have even more interest revenue that we have to record. How much additional interest would have accumulated on this note? Same formula. Face times rate times time. The note receivable has a face value of 240,000. The stated rate of interest was 5%. And time is going to be how long has passed since we last put interest on the books for this note. We put it on at the end of December, which means January, February, March, April, May, and June have all come to pass since we last made an adjustment to put interest on the books from this note. That is a total of 6 months. I'm going to multiply this by 6 out of 12, $6,000. And if I sum this all up, basically what's happening is they're paying us $240,000 for the face value of the note, the $4,000 worth of interest we already had on the books, and another $6,000 of interest that is accumulated in this case during 2026. And they owe us $250,000 in total. And here we collected note payments. And that's basically the gist of things. People pay you back more than the face value. We waited 10 months for this, but we got an extra $10,000 we would have not got had we not made this, we just made the sale at face value up front. And if you have a long enough notes receivable in there, an accounting period might end between the time that you receive that note receivable and when you actually collect on it. So make sure that you're being compliant with GAAP by adjusting for any interest accrued during a period when you report your numbers for that period. Let's do a similar run on this problem. So I'll flip over here to note number 2. In note number 2, Banjo is going to sell $3,000 worth of inventory to a different company called Toy Loft. And in lieu of payment, they're also going to sign in short-term notes receivable with us. We got different terms for Toy Loft, though. They're buying $300,000 worth of inventory. The rate on their note is 8%. We must think they're a little more risky than the Imagination Station. We're charging them higher interest, and the length of their note is only 6 months. Well, let's start right here. This is happening on November the 15th of 2025. So on 11/15, we got to start the same way that we did in the last problem. We are receiving a notes receivable, and that notes receivable has a face value equal to the value of the inventory, the sales value of the inventory that we sold them, which was $300,000. And we are making the sale right now, so we got to put the sales revenue on the books at this point in time. Also for $300,000. And here we sold inventory to Toy Loft and received note. December the 31st rolls around just like before. Interest has accumulated on this note between the time where we received it on November 15th and when our accounting period ends at the end of 2025. So just like before, we need to make an adjustment. The interest adjustment on a notes receivable is always the same. It's a debit to interest receivable over a credit to interest revenue for the amount of interest that is accumulated on this note during the accounting period. And I'm going to use the same formula. The face value of the note times rate times times. The face value of this note is 3,000. The rate is 8%. What is time? How much time passed in here, what kind of fraction can I use? Well, this is the dead middle of November, which means the second half of November had passed and all of December has passed. So how many months are between November 15th and December 31st? A month and a half. So my fraction is going to be 1.5, there we go, over 12. And it comes up to 3 grand. $3,000 is accumulated on this note during the 2025 business year. We adjusted for accrued interest on toy loft note. And our third requirement here on January 15th, 2026, we're going to kind of bring a factor into this. We've decided we don't want to wait around in this case for Toy Loft to pay us. They still have another, I don't know, 4 months left until we can expect payment because it was a 6 month note and it's 2 months from November 15th. We don't want to wait 4 months. We are going to sell this to a third party. So what is going to happen when we sell this to a third party? Well, first things first, we got to have the proper value on the books. This thing would have accumulated even more interest since December 31st, when we last put interest on the books. So let's get it current. Let's figure out how much interest it's accumulated between the very end of 2025 and January 15th, 2026. So my entry is going to be the same thing that I had before, except that's supposed to be a plus and not a minus. Apologies. Assets go up on the debit side. And we're going to have a credit to interest revenue as well. We're going to use the same formula that we did before. It's still face, which 300,000, just like before, times rate, which was 8%, times time. So how much time has passed since we made this adjustment? Half of January. So our fraction is going to be 0.5 out of 12. That comes out to $1,000, another $1,000 worth of interest accumulated on this note while we owned it before we decided to sell it to a third party. So we recorded accumulated interest on the toy loft note. And now that we're current and we've got all that interest in the value of this receivable in total at the time that we're going to sell it to this third party, it's all on the books. Now we can account for the actual sale of this notes receivable. So why are we selling it? To get cash. And it is a dead given of business that whenever you factor any type of receivable to another party, you are always going to incur a loss on receivable sale every single time. So when we know those two are going to be on the books, what's got to come off the books? We no longer are going to own this note from Toy Loft, which means we don't really have a notes receivable anymore. Whoever we're selling this to is going to be the party that's entitled to receive payment in the future. And that interest that we've been accruing on this note is no longer owed to us. The interest receivable has to come off. What are these numbers going to be for? Let's start with the credits, I guess. How much interest have we put on the books in total? Interest receivable got debited for $3,000 here, and it got debited for $4,000 here. This account would have a $4,000 debit balance. Take it off the books, we have to credit it for $4,000. Notes receivable. It's been sitting on our books this whole entire time at its face value of 300 grand. Well, that's got to come off the books. What amount of cash are we getting? It's given in here. We're selling it to this third party for $298,500. So we would have gotten 304 grand if Toy Loft just up and decided to pay us on January 15th early. But we know that's not going to happen. We want cash now. We factor to somebody else. They gave us 298,500. Well, what is that? That is going to be 304,000 in total minus the 298,500 we're actually paying, 5,500. We took $5,500 less cash than the thing was worth because we did not want to wait another 4 months to get payment. So here we sold our Toy Loft note.